what about gold? Is gold now too expensive? Is it potentially a good diversifier? We bought gold and silver roughly 1.5 years in premium because it was relatively cheap. So when we compared gold to other measures, when we compared it relative to the money supply, when we compared it relative to stocks, gold tended to be cheap, and the nice thing about gold is that it's not correlated to anything else. So it doesn't go up or down with the rest of the market. If the stock market crashes, gold can go up. When the stock market appreciates, gold can still go up. Gold also doesn't move in line with Bitcoin. And so if you want to have a diversified portfolio where things go up and down at different points in time, but long term they still appreciate, if you want to reduce our overall risk in the portfolio doesn't fluctuate that much, then gold is a good diversifier. At least it tended to be a good diversifier in the past. In the past, it very much looked like it was cheap, but that has changed with the recent rally. Have a look at this. This is now gold relative to US money supply. And this is a very long-term chart. So it starts in 1959. This is where our money supply data starts. So what we have over here, the dotted line, that's the average ratio of the gold price relative to the monetary base. And based on this chart, gold does not look cheap at all anymore, right? If it was to go down to this potential equilibrium price, it could fall from here by roughly 47%. Now, how could it fall by that much? It could fall by that much because the price is going down or because the monetary base expands. But the monetary base doesn't expand that quickly, right? It goes up by roughly 6.8% per annum. And so this drop over here would imply an expansion of roughly the next 10 years. So really, the main driver for this to come back to equilibrium would be the price itself going down. Now, what I believe when looking at this chart is actually that this dotted line, the equilibrium price, overestimates how well gold long-term does. And that's because gold has no fixed supply. Gold also gets mined every year, right? It expands by roughly 2% per annum. That's the new supply that hits the market every year on average. And so when something expands by 2% per annum, we shouldn't expect that versus the monetary debasement, it keeps completely its value. We should rather expect that when the monetary base expands by roughly 7%, a bit less than that, right, 6.8%, and when gold expands by 2%, that then gold in fiat terms should appreciate by roughly 5%. Right, so 7% because of the devaluation, less the 2% that gold itself expands, so 5% of appreciation in US dollar terms year over year. We should not expect that the gold price expands by the 6.8% per annum. So when we look at this chart, we should not expect that this ratio stays stable. Rather, gold should underperform USM2. Now let's take this peak over here, maybe not the very top peak over here, but this one over here. And let's see how much so far it has gone down compared to the current prices. The answer is 49%, roughly 50%. That's over the course of 46 years. Let's calculate what kind of depreciation should we expect over 46 years if gold was to underperform on this ratio by 2% per year. So we take our 2% per year and we take this to the power of 46 years. What do we get? We get an expected remaining value of 39% or a loss of 60%. We have seen a loss of 49%, maybe when we take the tip top to the current price, a loss of 59%, and that's pretty much exactly according to our expectations. So if we were not to align the gold price chart with the US money supply, but actually the gold market cap, where we don't have the data unfortunately here in TradingView, but if we were to align the gold market cap relative to the market cap of US fiat currency, then the peak that we've seen at the beginning of the 1980s and the current peak, they would perfectly align. But the reason why they don't perfectly align here is because we compare the gold price versus the monetary base. But actually, gold devalues versus the monetary base, at least that's our expectation, by 2% per annum. And so those two peaks on the market cap chart would align perfectly. And so what does this tell us? It tells us that I don't think that gold is necessarily that great of a diversifier again. I do think that gold is rather expensive. The problem also with buying gold right now is that if we do not time the market right, if we just buy into gold now and then we want to wait it out, quote unquote, that we then have to wait for a very, very long time, potentially forever, to get our purchasing power back, right? If you bought in the 1980s and you just went on this whole train, right? You bought the hype. You never got your purchasing power back relative to monetary debasement, right? You would still need more appreciation. And that would then mean a new all-time high of gold relative to USM2. Now, what we are implying here with this analysis is, of course, that the financial system is not going to collapse, that the US dollar will still be relevant, that America will still be one of the most important powers in the world, that nothing fundamentally is completely going to shift. And that's, of course, potentially a strong assumption because the US dollar, for example, isn't used as a reserve currency that much anymore. So there might be some kind of a power shift, and it might be true that whatever replaces the US dollar potentially could then also be backed by gold, and that of course would support the gold price at that point. But what this also means is that what we see here on this chart is pretty much the maximum we can expect in gold appreciation if the global power dynamics were not to change anymore. If the global power dynamics stay the way they are, then gold right now, I believe, is extremely expensive. And I don't think it's a great time to buy gold right now at those levels. Unless, of course, you just buy a hedge. If you buy a hedge in your portfolio with a small percent, right, with like 2, 3, 4, 5%, a hedge against the general market collapse, that you've got at least some purchasing power in case everything comes crashing down. And of course, buying gold might make sense. But if you're now buying gold just for price appreciation to jump on the current momentum, I think that's very dangerous. I don't think that's the right thing to do.